All right. So, we've been getting a lot of questions about tariffs.
Oh,
and
yeah.
and it seems like everybody's kind of like, is this a big deal or is this not a big deal? Or,
Right.
how are we supposed to think about this thing? And
Yeah.
so we're calling this, tariffs, the tariff tape bombs of 2025. I like that.
I kid you.
Yeah. So that's what we're going to dig into today and,
Okay.
try to help you understand how to think about it and how it affects you and what you
Right.
might do about it.
Yeah. You know, there's this feeling of uncertainty right now.
Yeah.
And it can be kind of paralyzing, but we really want to move beyond just acknowledging it.
Right.
What we want to do is really unpack this.
Yeah.
What could these tariffs mean for the economy,
Yeah.
for inflation? What's the Fed going to do? How are companies going to perform?
Yeah.
And, of course, how does this impact your investments?
Exactly. And, as you're thinking about your portfolio this year, we want to give you some ideas, maybe some strategies to almost tariff-proof it.
Right.
Because while things can sound pretty doom and gloom,
Yeah.
when there are big economic shifts,
Yeah.
there are often opportunities that emerge.
Yeah. That's
And we
right.
want to help you find them.
Yeah, it's interesting that this whole tariff thing feels very new and sudden,
Uh-huh.
but it actually goes against this long-standing global trend
Yeah.
for decades, really since the 1930s.
Right.
The world has been moving towards lower tariffs
Yeah.
and, more globalization.
Right.
So this is really like a turning of the tide,
Yeah.
a real shift.
Yeah. Okay. So you sent over this really interesting stuff from mapsignals.com.
Yeah.
And they really dig into this whole shift in trade policy.
Yeah.
And they really emphasize, how the global market for goods,
Right.
which is huge, by the way.
Oh, yeah, it's a $24 trillion.
Yeah, $24 trillion. It's been totally upended.
Exactly. And it's not just about tariffs on, countries we think of as rivals.
Right.
We were seeing these pretty significant tariffs on,
Yeah.
our free trade partners, North America, Canada, Mexico,
Yeah.
our allies in Europe. And
Right.
I think what's really interesting is what the author, Alec Young, points out
Yeah.
are these, what he calls reciprocal tariffs
Okay.
that went into effect on April 2nd.
Okay.
And these specifically target nations that, consistently have this
Yeah.
big export surplus with the U.S.
Right. So they're sending way more stuff to us than we're sending to
Right.
them. And
Well,
so we're
it's-
saying, okay, well,
Yeah.
you're going to
play hardball.
Yeah, we're going to play hardball too.
Yeah.
And when you actually look at the numbers, it is kind of mind-blowing.
Yeah, it is.
So for China, you're looking at about a 54% total tariff impact.
Okay.
Then the EU's at 20%, Japan 24%, UK 10%.
Yeah.
And it goes on and on. Brazil 10%, India 26%,
Wow.
Vietnam 48%, South Korea 25%, Switzerland 31%, Indonesia 32%.
I mean, it's
It's a lot.
really wide-ranging.
Yeah.
And, of course, as you can imagine, this has not gone unnoticed.
Right.
China and Europe have both come back with their own tariffs on U.S. goods.
Of course.
And so you can see how this could easily escalate
Yeah.
into a, tit-for-tat trade war.
Right.
It's kind of a classic,
Yeah.
scenario that can be really hard to contain once it gets going.
But the thing is, not all of these tariffs are set in stone.
Right. That's a really important point.
Yeah. The information that you sent.
Yeah.
It highlights that there's a lot of negotiation happening.
Yeah.
Some countries are trying to figure out ways to avoid these tariffs altogether. And so it's not like a done deal.
No, it's very dynamic. And
Yeah.
really the economic fallout will depend on what happens with these discussions and whether, some of these tariffs get scaled back or maybe never even fully implemented.
Yeah. And I think even the fact that they're just, being talked about and that there's this uncertainty can have a big impact on what actually happens in the economy.
Absolutely. And that brings us to the potential economic impact.
Right.
For you.
For all of us, for everyone.
Yeah.
So there were these calculations from Evercore ISI
Okay.
that were mentioned in the stuff you sent.
Yeah.
And they paint a pretty stark picture.
Yeah.
They say that if all these announced tariffs actually go into effect, the average tariff rate on goods coming into the U.S. could jump to 29%.
29%.
29%.
That's huge.
It's a big jump.
Yeah.
I mean, think about it. We were at 12% before April 2nd.
Yeah.
And it was only 2.4% in 2023.
Right. So it's a huge jump.
It's a really significant increase. And there's a chart in your materials that really kind of drives that point home.
Yeah.
And so the consequences of this kind of sharp increase,
Yeah.
they kind of break down into two main things. Slower economic growth.
Okay.
and higher inflation.
Right.
And, the way to think about it is,
Higher tariffs, essentially, they're just like an extra cost on goods.
yeah,
Whether it's raw materials for businesses or finished products for consumers.
right.
So this can lead to businesses, cutting back on investment hiring.
Yeah,
And ultimately, you end up paying more for everything.
right.
And so this, higher cost structure,
Right.
it squeezes corporate profits.
Yeah.
And then that puts downward pressure on stock valuations.
So then the question is, for investors,
Right.
have we already kind of priced in enough concern?
Yeah. Have markets adjusted enough to account for this?
Yeah.
It's really tough to say right now.
Right.
There's just a lot of uncertainty baked into the market right now.
Yeah.
And we're actually seeing this play out in how people are talking about corporate earnings.
Mm-hmm.
Going into this first quarter earnings season.
Right.
The expectation was that with all this economic uncertainty,
Mm-hmm.
companies would probably be really cautious,
Yeah.
maybe even negative, in their guidance for the future.
Right.
I mean, it makes sense when the outlook is murky.
Yeah.
Management teams, they want to play it safe.
Yeah.
But here's where it gets interesting.
Okay.
When you actually look at those earnings forecasts,
Yeah.
despite all the, tariff talk and the economic uncertainty,
Right.
the consensus estimates for earnings over the next 12 months have actually held up pretty well.
Wow.
They even hit a new all-time high recently
Yeah.
of $276.40.
Yeah. You had a chart showing that
Yes.
it seems a little counterintuitive.
Yeah, there's this underlying optimism
Okay.
that seems to be kind of propping up those earnings forecasts.
Okay.
Like as your material suggests,
Yeah.
there's this hope
Okay.
that a lot of these, threatened tariffs,
Yeah.
they might not actually happen.
Right.
Either because of trade negotiations or maybe they just don't last that long.
Okay.
And this hope is definitely kind of,
Putting a floor under things.
yeah, providing a buffer for those earnings expectations. But the author of this piece makes a really important point.
Okay.
Until we know for sure how these tariffs are going to affect the economy and company earnings,
Yeah.
making a strong case for the stock markets to just surge to new highs,
Right.
it's just going to be difficult.
Yeah.
I mean, we're kind of in a waiting game.
So we've got a lot of uncertainty.
A lot of uncertainty.
Yeah, we might have some bumpy trading ahead of us.
Yeah.
It's helpful to kind of step back
Yeah,
and look at history a little bit.
absolutely.
The information you shared
Yeah.
talks about how bull markets tend to behave, especially in their third year.
Right. So historically, the third year of a bull market,
Yeah.
it tends to have more muted returns
Okay.
compared to, those first couple of years
Right.
where you get those really strong gains.
Right.
So it's kind of like this period where the market consolidates,
Yeah.
kind of digesting those earlier advances,
Right.
almost like, catching his breath.
Okay, so it's almost like, we had the big run up. Now we're kind of taking a pause
Yeah.
before the next move.
Yeah.
So this consolidation period
Yes.
lets the market reset,
Right.
and then the pace of the bull market can potentially pick up again later on.
Right. Assuming that the bull market continues.
Okay.
And so this is important for you as you navigate 2025.
Okay.
Because if this pattern holds true,
Hmm.
it means those kind of broad, easy market gains
Yeah.
might be a bit harder to come by.
Okay.
And so as the source says, stock picking becomes really crucial.
So it's not just about being in the market. It's about choosing the right things.
Exactly. You got to be much more selective.
Okay, so let's talk about that. How should people be thinking about building their portfolios with all this going on?
Well, I think a good starting point is to look back at how different sectors of the market performed
Yeah.
in the first quarter of 2025.
Right.
And what's interesting is that the sectors that did really well,
Yeah.
they seem to have this shared characteristic. We might call it a margin of safety.
Okay.
It wasn't necessarily the high growth, high risk areas.
Right.
So the leaders were energy and financials.
Okay.
And those are considered relatively undervalued right now.
Okay.
And they offer pretty attractive dividend yields.
Okay.
And then we also saw strength in these more defensive sectors.
Yeah.
Consumer staples, utilities, healthcare.
Right.
These are the companies whose earnings
Yeah.
aren't as affected by, economic swings.
Okay, so they're kind of steady.
Yeah, a bit more stable.
Yeah.
And, there's a good chart in your materials that shows this.
Yeah.
And what's really striking is that this year-to-date performance
Yeah.
across different sectors, it actually lines up really well
Okay.
with how those same sectors have historically performed during economic slowdowns. I
Interesting.
mean, going all the way back to 1960.
Wow.
The historical data shows that healthcare, consumer staples, financials, and utilities,
Okay.
they've generally done the best when the economy cools off.
So maybe people are kind of instinctively, moving towards what has worked in the past?
It's possible. And the source actually connects this historical pattern to what big institutional investors are doing right now.
Okay, so like the big money.
Yeah, exactly.
Yeah.
So we're seeing these huge inflows of capital into utilities, financials, staples.
Okay.
And those sectors are actually at the top of
Yeah.
the sector performance charts,
Okay.
according to the analysis you shared.
Right. So it's like the smart money is...
Yeah, it seems like they're following this historical playbook for slowdowns.
Okay.
And energy is also really popular right now.
Interesting. Why is that?
Well, oil prices have kind of calmed down a bit
Okay.
after that recent dip.
Okay.
But I think the bigger factor is that the energy sector,
Yeah.
right now, it offers the highest total return to shareholders in the entire S&P 500.
Okay. How much are we talking?
We're talking a substantial 6.5%.
6.5%.
Which includes a really nice dividend and a lot of stock buybacks.
So they're returning a lot of cash to investors.
They are, and that's especially appealing when inflation is sticking around.
Right, because you're actually getting something back.
Exactly.
Even if the market's not doing much.
Right, it gives you a bit of a hedge against inflation and potential downturns.
Right.
So it makes sense that it's really popular right now.
So if we're trying to, kind of tariff-proof our portfolios, it sounds like we're going back to this historical playbook for slowdowns.
Exactly. It's about focusing on those sectors that have shown they can weather the storm.
Okay, and those sectors are?
So we're looking at financials, energy staples, utilities, healthcare.
Okay, so really what we want to do is find those great companies?
Yeah, the high-quality companies.
Yeah, within those sectors.
Exactly.
Okay, and how do we know if they're great?
Well, you want to see if they're attracting a lot of investment.
Okay.
And the source you shared uses something called a MAP score.
Right.
To gauge that institutional buying interest.
Right. So are those big institutions putting money in?
Exactly.
Okay.
And for those of you who are MAP Pro members, they actually have this detailed report that showcases their top 5 stock picks in each of those sectors.
Oh, cool.
All ranked by MAP score.
Okay. That's really helpful.
Yeah. Can give you a real leg up in this kind of complex market.
Okay. So let's wrap things up here.
Okay.
Main takeaways.
Yeah.
Tariffs are definitely creating a lot of economic uncertainty.
Absolutely.
They could slow down growth, push inflation higher.
Right.
But history tells us that some sectors tend to do okay.
Yeah, they're more resilient.
Yeah, during these slowdowns.
Exactly.
And right now, it seems like those sectors are...
So energy, financials, staples, utilities, healthcare.
Yeah, those are the ones that are attracting the most attention.
Yeah, and they seem to be performing the best.
Right.
Which aligns with, what we've seen historically during those economic cool-off periods.
Yeah, so as you're making decisions about your investments in the coming months...
really think about these trends.
Absolutely.
Where is the big money going?
Right.
What's worked in the past?
And here's something to think about as you kind of process all of this.
Okay.
We've been talking about these concerns about tariffs.
Right.
But how might these patterns of sector performance and these shifts in investment flows be telling us something bigger?
Okay.
Like, what if they're pointing to some more fundamental changes in how investors are feeling and what their priorities are?
Right.
What shifts are happening in the market that go beyond just this tariff situation?
Okay.
It's worth taking some time to think about what these trends might be telling us about the longer-term direction of the market.
Yeah, it's like, what are the second-order effects here?
Exactly.
That maybe we're not even thinking about yet.
Right.
All right. Well, that is all the time we have for today. Thank you so much for listening.
Thanks for having me.
And we'll see you next time.
See you later.